Welcome to STRAT this week. It's May 1st. Woodall, Mike Rarey. We're going to talk about April. It was quite a month. A lot went on in April. A lot of interesting things in the markets, the Fed. We had some GDP numbers, so lots to talk about. We had also JPMorgan taking over First Republic, acquiring First Republic. We maybe touch on that a little bit towards the end, but let's first start and look at the returns for the month of April. Put them up on the board here. Walk us through them.
That second column from the left, month to date, is the month of April, and you can see equities really just in the last couple days of the month squeaking out a gain. Large cap stocks, up over 1.5%. The S&P 500. If anything led the way, it was more value-oriented stocks, and you can see that when we get into looking at sectors on the next page. But what started to happen here, if you look at the one-year return figures, large caps are now positive on a year-over-year basis. And so that's flipped some of the price regimes from high or low and falling to now rising. The other thing that's done, that combined with very low traditional volatility measures, things like the VIX, what that's basically meant is a lot of trend following, systematic type equity strategies have been buying and have now sort of nearly maxed out their equity exposure. So that sort of momentum, technical tailwind that equities had thus far year to date should basically be exhausted at this point.
So when these trend following managers reach their max positions, they can't buy anymore unless they have new money.
Yeah.
So that just generally adds to the potential for a pullback.
Yeah.
Right?
Yeah. Either they get new money or volatility falls even more. But volatility is already so low, that's unlikely.
Right.
Yeah.
Right. Okay. Well, let's look at the sectors. It's a new chart for the month, and looking underneath the equity markets and seeing what sectors are doing well and what sectors are doing poorly. We can highlight because there's a lot going on underneath the surface here.
Yeah. About halfway down the page, month to date column, energy, financials, healthcare were your big winners for April. Quite different from the year to date trends, but within energy, energy companies, the big integrated oil companies continuing to post very strong cash flows and earnings. And we also had the surprise production cut very early this month that helped out a little bit there. In the financial sector, the large diversified banks did very well because it's very clear that they're going to come out as the winners amongst all this deposit migration and failure of smaller regional banks. Regional banks actually still lost money in aggregate during the month of April. Of course, First Republic was the biggest loser, although it wasn't a big weight in the index at this point. And healthcare did well also. So quite different from year to date, where you look at over in the year to date column, Infotech, the huge winner. I mean, just a handful of stocks representing not only the majority of those Infotech returns, but the majority of the S&P 500 returns.
Right. Yeah. I mean, if you take out some of those, I think it's like 5 stocks, the market's pretty close to flat. So
right.
A lot going on there. Why did the tech stocks rally so much?
Yeah, this is a great question. And, within our framework, tech is most sensitive to liquidity. And when we get to liquidity, we're going to show, well, the liquidity picture is ugly. So it's just going to sort of reinforce the necessity of your question. Why did tech stocks do so well? Right. But when we look at net liquidity, we think that, sort of paints the picture. So we can probably
dig in there.
Yeah.
Okay. Let's turn to fixed income.
And fixed income, April was another solid month in terms of yields coming down across the treasury curve. You look at 2-year, 10-year, 30-year maturity breakpoints all making money. And now we're at the point where, if you look at our yield regimes all the way out and to the right, yields across pretty much the entire fixed income spectrum are high, which is great, great starting point, and falling, great technically. So, being invested in bonds has been great year to date. You've made a good amount of money. Unfortunately, if you were overweight bonds by being underweight things like growth equities, right, you missed out on some gains.
Yeah.
Yeah.
And the fixed income market is saying something very different than the equity market.
Yeah.
Right now, at least. And maybe we'll touch on what we've seen so far in Q2 earnings, Q1 earnings coming out.
Yeah.
So, alts.
Alternatives, commodities having a negative month. And, we talked about these different price regime changes and yield regime changes, all opposite from last year, right? Commodities has also flipped into a less favorable price regime. It's now low and falling. So you see, year over year, down over 16% for a broad basket of commodities, and energy, the primary detractor there, down over 30%. And so, oil prices coming down. That's good news for inflation in terms of it hopefully continuing to come down. But, bad news for a diversified basket of commodities.
Right. And it usually, just historically, when oil prices start to come down, they do have a tendency to come down right before the start of a recession also.
Right.
So, let's look at liquidity and the big change in liquidity that our forecast shows here.
Yeah, and starting off with the solid blue line, which are the actual year-over-year M2 numbers, they just keep surprising to the downside. I mean, down 4.1% year-over-year through March, so March to March. And once again, this is the first time in history we've ever seen negative money supply growth, that the money supply has ever shrunk on a year-over-year basis. Normally, when the Fed goes through a rate hike cycle, we know that bank reserves go down. Rate hikes drain bank reserves from the system. Reducing the size of your balance sheet drains bank reserves from the system.
Right.
So that always happens in a rate hike cycle. That's the downward force here. But typically, that can be overcome by currency in circulation increasing. It almost always does. And bank deposits increasing. And those things offset. But in this instance, those other two things have not offset, not even close. And now there's 850 billion fewer US dollars in existence today than there were a year ago. And almost all of that comes from reserves being drained from the banking system faster than we've ever seen because of the pace of this rate hike cycle.
And how does the reserves being sucked out of the banking system affect the real economy?
Yeah, I mean, reserves are the tokens that essentially that banks use to create money and loans. And so if there are fewer reserves, that just means there are going to be fewer loans. There's going to be less credit extended, and economic growth is going to slow. So
let's translate that into net liquidity, which we use a lot for determining what the market value of the equity market should be trading at.
Right. And so liquidity, you see that chart and you say, well, why? Back to your earlier question, why has tech rallied so much? Because that doesn't make any sense. Well, the liquidity picture affects the next 12 months. The net liquidity picture is more, couple weeks, couple months, more short term. And if you look at the net liquidity picture, this green line, it's actually up thus far year to date. It's actually up relative to last October, which is when growth stocks really started doing well. And the reasons for that are, Fed assets have come down somewhat, but then all of the loans extended to FDIC bridge banks that assume Silicon Valley, Signature Bank, et cetera, the bank term funding program, all these other loans that have been used by the banks during the banking crisis we've experienced. So that's increased Fed assets somewhat. And then reverse repo was flat. So that wasn't sucking money out of the system year to date. And then the Treasury General account was being spent down. So money was being put into the system from the Treasury General account. And so this net liquidity picture, which was awful, from late 2021 through late 2022, it didn't get better. It just technically stopped getting worse. Even though the year-over-year M2 liquidity situation kept getting worse.
Kept getting worse,
Net liquidity stopped getting worse. But now, once again, you go through each of those factors, you think, well, these loans for the banks, those are being used less, so the green line should come down, Also, the Treasury General account has been spent down. I mean, it's down to the lows it was prior to the last time we had debt ceiling problems in late 2021. So it's starting to come back up now, which sucks money out of the system. And the last thing is reverse repo usage is at an all-time high because you're a money market fund, you're sitting on cash. There are too few treasury bills being issued for you to invest in, because we can't issue new debt because of the debt ceiling.
Right.
So you're reverse repoing. So you're taking the cash you have and you're sucking it out of the system as well. So basically that means we think green line is going to be heading down. It already is. And it could head down pretty quickly here, especially if the Fed follows through with a rate hike here this week and continues to draw down their balance sheet. So
the suspension of equity prices far above this projected line is based on hope?
Yeah, based on hope of cuts, hope of rate cuts. Yeah.
So right now, I don't know where the market implied rate cut potential is for today. If you'd look, I don't know if you'd look, but
yes, May we're expecting a 25 basis point hike, potentially another hike in June, and then the market is expecting aggressive cuts.
Right.
Yeah.
So that would mean that basically we're going to hike rates one or two more times and then start pulling them right back down, which makes no sense whatsoever.
Right. Yeah.
I mean, the Fed would pause first.
You would think that the Fed would learn the lessons of the 1970s and be very hesitant to cut rates. So good news, they're going to stop hiking. Bad news, they're just going to keep rates at a contractionary level for potentially an extended period of time. Mm-hmm. So
yeah, 5% overnight rates are not something that the real economy right now can deal with on a longer term basis.
Right. Right.
Things will really start to break. So let's move to the inflation question, because we need to see more evidence of inflation coming down, right? In order, so with the Fed hikes one for sure, maybe two, it doesn't mean for certain that they're done.
Yeah.
So walk us through the inflation.
Yeah, the inflation picture is not getting better fast enough. If you look at headline and core CPI and our forecasts out to the end of the year, they're still running well above the Fed's 2% target. And mid-month, we're going to get the April inflation figures. And by all accounts, those on a year-over-year basis are going to be running in the fives, with a 5 handle on them. So definitely the year-over-year numbers and the broad aggregates are not signaling that the Fed can stop hiking rates. It's certainly not signaling that it's time to cut rates. They're saying that there's more work to be done here, and then we're going to start hearing more and more about the idea of supercore inflation, and that is certainly saying that the Fed has more to do as well.
So let's I think we have a chart here. Is that next?
Yeah.
Supercore. So that's a segue, because they've mentioned supercore several times, and people are like, well, it's just another term. It really doesn't matter, but they seem to talk about it. So what is it? Why do they use it versus core? What's the advantage?
Yeah, should have come up with a better name for it, to be honest with you. Supercore doesn't really imply what it is. What it is you take core CPI, you isolate the services component, and then you take out housing. So why is this so important for the Fed right now? What does that measure? It seems like we're really breaking down the core basket, maybe too far. The reason is because services inflation have the biggest potential knock-on effect for wage increases. Yeah. The services sector is the most wage-intensive area of the economy. So if services inflation runs too hot for too long, that's where you risk going from goods and services inflation to a wage price spiral. So that's why the Fed is so laser focused on that. And then why do you strip out housing? Well, because there are a number of different things within housing that really have no economic impact, like owner's equivalent rent is going up. Well, like, what does that even mean? If I own my house, if I were to rent it, I could rent it for more this month than I could last month. Right. It's really irrelevant. It's a cost borne by nobody.
Right.
And it makes up a huge chunk of the services bucket. So you strip that out because it's noisy. And now you have supercore. And
so give an example of like getting a haircut is an example of a supercore.
That's
right?
Supercore, yeah. That is, haircuts are supercore, exactly.
But give some examples of supercore and why, like how the wage impact is the real issue here.
Right. I mean, if you look at dining out at restaurants and things.
There you go.
Yeah, that would be very sticky. Why? Because think about all the people that had to be involved in making your meal and bringing it to you, right? And so if the prices of that good or service are going up, well, that probably means that all those people that get paid to deliver that are also getting pay increases. And then that can be a self-reinforcing cycle. So that's super cool.
That's harder to undo versus a commodity type inflation, right?
Yeah. Or take goods, used cars, prices go up and down.
Prices go up and down, right.
I mean, but if you run a restaurant, you're not just going to be increasing and then cutting people's wages dramatically. That's not going to work. What normally happens is you increase them and then you can't afford them, so you fire them.
Right.
That's how it works in the U.S. at least. So that's why Supercore right now running at 5.8% year over year. And then if you just look at the last 3 months, you take the moving average and annualize it, which is more like, how is it looking right now? I mean, it's at 5%. So that's hotter than the other big inflationary metrics, and that is a problem for the Fed.
So for all the bulls looking for these rate cuts back half of the year,
you should be cheering for Supercore to come down really hard.
Got it. Okay. Let's move on to economic growth, because we did get the GDP print. And maybe just address, for those of you who follow the GDP forecasts, the Atlanta Fed's forecast, like they must have known something, because the day before it was released, they nailed it right on the number and cut it by 1.4% or something.
Yeah.
So,
and it was ultimately, if you look at the Atlanta Fed's forecast model, yes, it did seem a bit too much of a coincidence. Yes. But in reality, there was a revision to retail sales numbers that came out right before the GDP number was released, and that ultimately brought their estimate down. I don't think there's anything sketchy going on. But when we look at economic growth for our framework, we look at real GDP growth year over year. That's different from the number that gets reported every quarter, which is quarter over quarter annualized, much different. So on a year over year basis, we expect 4 quarters out for real GDP to be running at about 10 basis points. So that's low and falling. And if you specifically talk about the Q1 number, which came in at 1.1% quarter over quarter, seasonally adjusted, annualized, under the hood, it was actually a lot better than that, because what happened was there was a huge inventory drawdown of 2.2%. So that's a negative impact on the number. So it was 1.1% in spite of that. And the in spite of all came from consumption, goods and services, which we've talked about this before multiple times. If consumers are going to open their pocketbooks, spend down their savings accounts now, all that means is they're going to run out of savings sooner. And so a lot of spending right now, it's good news now, but it means potentially slower growth later. So we definitely had that. So the consumption was really strong. And then housing was its smallest negative contribution or detraction since Q1 of last year. So everybody's sort of gotten through the whole whatever stage of grief they're in to accept 7% mortgage rates, and they're just doing it. So the housing market wasn't as bad as we thought either.
Yeah. Government spending was stronger than expected.
Oh, it was great. Yeah.
And that's usually not a good thing.
Well, no.
So there were some clouds inside there. But in terms of the remainder of the year, you say 10 basis points. How does that sort of evolve from Q2 through Q4?
Yeah, the expectation is Q2 will be just slightly positive, something like 30 basis points. Q3 and Q4 could very well be negative. And then we actually, in this chart, actually show Q1 2024 as well. That should be positive. But, that's just a throw-in number, because nobody really knows that accurately.
Okay. Yeah. So given all that, how does that change our recession forecast?
Some movement under the hood, but not a lot of change overall. I mean, still well above 50% probability in the next 6 to 12 months. 3 months right now haven't moved a lot. What the big inventory drawdown during Q1 did for the recession indicator is about halfway down this list. You'll see new orders to inventory ratio is back to 1. It was below 1, which was a bad thing, meaning companies weren't ordering new stuff. You know, they had too much inventory, burned through a lot of inventory, so that was good. So that was helpful. But anything here related to the yield curve is like all-time bad outside of a recession. Like it's you know, if the yield curve still matters, it should really start mattering soon, because this is pretty bad in terms of Cleveland Fed, New York Fed, percentage of yield curve inverted. You know, if you just look at the front end of the curve, that's heavily inverted. You know, the things that the Fed watches, you know, front end spreads, those are super inverted. So we think the yield curve is going to start to matter. Yeah.
And so in terms of recession, so what's the probability we'll be in a recession this year versus maybe 24?
Good question. Well, I mean, our indicator would say, you know, there's a little better than a coin flip odds that at some point this year we'll be in a recession. And if it doesn't happen, you know, one scenario could be the Fed raises rates to 5 to 5.25, or maybe they even have to raise them more than that because the economic growth is just stronger than expected. But then we come into 2024 with, you know, overnight rates at an extremely restrictive level, and they have been that way for a long time, and costs of bank deposits are creeping higher and higher, and loan growth is slower and slower. So it's almost like if it doesn't happen this year, it's not like the probability gets lower next year. If anything, it might get higher. So.
Okay. And so in terms of sort of where we stand today, where rates are, what impact, and we'll leave this into the JPMorgan First Republic, what impact will this continue to have on the banking sector? Part one. Part two of the question is, as I walked through the halls today, and pretty much the building's empty. People aren't coming back to these offices, or at least they're not coming back anywhere close to what they were coming back before. How does the commercial real estate market play out and impact the potential for the small and mid-sized banks?
Yeah. Yeah, I mean, if the Fed's going to keep raising overnight rates, and those overnight rates are going to be so much higher than deposit rates at banks, at the big banks and the small banks, but just such a huge gap. You know, if banks have to pay their depositors, I mean, it's not even talking about getting all the way up to the Fed funds rate, but just 1% more than they're currently paying them, you know, the math doesn't make sense for almost the entire U.S. banking system, in terms of, like, they have negative net capital at that point. So that obviously can't happen, because then all the banks would, you know, cease to exist. But what will happen, and what we think will continue to happen, is depositors will realize what's going on here. And the more the Fed hikes, the more attractive something like a money market fund looks for your savings relative to keeping them at a big bank. And banks are just going to lose deposits. And you know, the more and more that banks lose deposits, the harder it is for them to originate new loans, and businesses are going to lose out. And it would be nice to think that, oh, well, we have this taken care of, because look, like JPMorgan's just going to absorb all the banks eventually. You know, end game is all deposits are at JPMorgan, right? But it doesn't work that way. Like, the smaller banks actually service certain areas of the economy and the financial system, and they're allowed to do that because they're subject to different requirements and regulations than the big banks. So it would be nice to think, oh, this small regional bank in Texas is going under, JPMorgan's going to buy them, and so now JPMorgan's going to do all the commercial real estate loans that Texas bank was doing. Absolutely not. No. Because JPMorgan is subject to totally different capital requirements, and they cannot do commercial real estate lending, you know, to the level that some of those smaller banks can do. So it's not just all going to absorb and work out. It's a bifurcated banking system, and the banks that are failing serve a very important role in terms of economic growth, particularly around, like, commercial real estate.
So what has to happen in order for the banks to survive a potential extended period of high interest rates, high short-term interest rates?
Yeah, so there aren't a lot of good options. I mean, if you looked at like First Republic, for example, which I know is an extreme, but just as a logical extreme, the only solutions there were they somehow get a massive inflow of deposits that are willing to be paid next to 0%, or the Fed cuts interest rates to 0%. Those are it. Those were the only things that were going to organically solve the situation, right? And then you just have sort of, less extreme situations of that. Other banks that are, have the same sort of balance sheet situation, just not as bad. Mm-hmm. And it's the same thing. I mean, I either need to get a whole bunch of free deposits that I don't need to pay for, or the Fed needs to cut rates to 0. I mean, that's basically it. The longer the Fed keeps rates at 5, and the more that depositors know about it, it's sort of like a slow burn.
Yeah,
it's just going to keep happening.
Yeah, the cat's out of the bag. So, JPMorgan acquired in an open bidding process. I don't know how many banks bid on it, but I know there were several. Acquired the deposits and certain assets of First Republic, but not all the assets.
Right.
I don't know if you can speak to the details of what they acquired and what they paid, et cetera.
Yeah. So basically, the big thing is they got sort of a sweetheart deal from the FDIC, so a loss share agreement. Mm-hmm. So that was great, and this is a big reason why First Republic was never going to get bailed out before it went into receivership, because of the precedent the FDIC set with Signature and Silicon Valley Bank, where, hey, anybody who wants to buy these assets before it goes into receivership, just wait, because if you wait until it's in receivership, the FDIC is going to fire sale these things, and you're going to get whatever you want. You won't have to buy anything you don't, and you might get some help on any potential losses. And then the FDIC says this will cost them like $13 billion. So we're up to like almost $40 billion in total losses to the FDIC, Federal Deposit Insurance Fund, because of this. So it just goes to show there will not be private market solutions now. We have 3 situations where if you're a bank looking at buying a troubled bank, just wait.
Just wait.
You'll get it for cheaper, and you'll get a way better deal. So, yeah.
Okay. Likelihood we're going to see more of these?
Tough question. I have no idea. I would like to say this is the last one, but that would be stupid to say.
Yeah. I would sense that there's probably a few others lurking out there that might raise their heads up. But is this, maybe the better question, is this systemic to cause a financial crisis?
Well, the difference between this and like 2008 is there are no toxic assets.
Right.
So that's where this is more like a nasty bank consolidation period, probably more like the savings and loans crisis in the early 80s, actually much more like that than the 2008 global financial crisis.
Yeah.
So no toxic assets, probably not systemic. Yeah.
All right, well, thanks for joining us for the monthly update. We'll be back next month to talk about the month of May. And until then, if you have questions, reach out to us.